I think it is important to acknowledge that there are very different types of investors, and each investor can have different types of risk profiles, return requirements. And I found sometimes when partnerships haven't necessarily gone the right way, it's because there's probably been a mismatch in terms of how the franchisor or the franchisee has been pitching the business and the type of investor they've been after versus the type of investor they've actually got.
Representing Franchise Secrets, Eric Von Horn.
Adam, welcome back, man.
Nice to be back, Eric. Thanks for having me.
We should have hit record. We started talking 20 minutes ago and had interesting conversation as usual. We just need to make a podcast where it's just the pre-show conversations. Like that would be an amazing podcast. That'll probably be the best podcast, I would imagine.
Probably get some very good nuggets.
I think so. All right. So you've been on before. You're one of our partners at Front Street in some different ventures over there. You have a lot of franchising and business experience. Give the audience just a brief recap of like who you are, but I also want you to do it different than before. Weave in the non-franchising stuff that you do, because I'm out there in the world of entrepreneurs and talking to people, and there are people that have a hat of something else in entrepreneurship. And then, by the way, I own X amount of Jimmy John's, or I have these hotels, and it's like they have a franchising piece to their life, but when they're out in the world, they're talking about so many other things. So like if you were introducing yourself to somebody in the Hamptons that doesn't know anything about you, like how would you explain who you are, what you do?
I'm not sure I've actually got a very good answer for that. Entrepreneur just sounds so 1980s, I think, in its term, and it feels so broad and unspecific. Okay, so let me challenge accepted, Eric. Let me see if I can do this a little differently. I guess the traditional bits first. I did, the first 15-ish years of my career, I was doing mergers and acquisitions work for a lot of sort of Fortune 500 companies. That's advising them on buying businesses, selling businesses, structuring joint ventures, license agreements, all sorts of different transactions, equity financings, debt financings. Some things we'll get into later today or another time. And that was great experience for me. Ultimately, I think a stepping stone to where I've been for the second 15 years of my career, which is a lot more, I think sort of entrepreneurial. And for me, that's been, I founded a number of businesses. I've run a number of them. I know where I fit in the food spectrum. So I usually run it for a point in time, and then I transition out to get the right leaders in to then execute the business in a way that I can't. I've been an active investor. I've been a passive investor in a handful of private companies. Over the last few years, I've actually ended up doing a lot of, sort of like one-on-one coaching advisory work with CEOs. Basically just been in the background, been a sparring partner for them as I look to pull them out of being in the business and get them on the business, whether that's around like how they hire their team, how they think about an exit, how they think about prioritizing the right work. And I think, as we were actually just talking, before you hit record, I think in this world of AI and the fact that this like accelerating rate of change continues to accelerate, I think it's also just forcing a lot of us to like reinvent how we're doing things. So I think there's a lot of like pattern recognition and muscle memory. And I think a lot of it is well served for what's to come. But also like the prior ways of building business in the last 10 to 15 years is increasingly outdated and irrelevant what's going to be like a next generation of brands and businesses. So I think that's going to be my challenge. But as things evolve, to my mind, I think what's more constant in terms of what I'm looking for is I want to support great leaders, and I want to personally be involved in building great brands, great businesses with great people, have a no asshole policy, and you do it by being profitable and keeping costs in check.
Well, we're going to be talking about, whether it's all in this episode or we record a couple episodes around like structuring your entity as a franchisee and a franchisor, different entity structuring, and then raising capital, raising funds to grow. And I was just talking to a friend of mine yesterday who is interviewing or being interviewed by a handful of private equity companies that are wanting to inject capital into his business as a franchisee, and the multiples that they are they're valuing it at is around an 8x, so that it will give some capital injection to the franchisee who's been growing a substantial business, and it will give them the capital to continue to grow and expand, and yet he'll be able to take some money off of the table as well. And there's a lot of different ways to raise capital as a franchisee or a franchisor. So Adam, I brought you on because you're a genius at this stuff, and you're very good at explaining how some of the complexities actually work. So my goal in these conversations with you is for the audience to start to understand the different ways that they could structure their businesses, raise capital, and expand, different expansion type opportunities, whether it's as a franchisee or a franchisor. We'll probably naturally talk a bit more of the franchisor side of things, and then we will weave in there how this applies to franchisees, because they apply to both. It doesn't mean you have to have like a private equity type investor. It could be friends and family. It could be somebody like me that puts in capital into deals. You put as an investor, you put capital in deals in different ways as well. At the Tribe of Investor and Lifestyle Investor Masterminds, we're always talking about this kind of stuff. So to set the stage, I want the audience to be able to listen to this and use this as an opportunity to learn different terminology and to understand it. So when the time does come, you're ready, a lot more ready than you are today. So where do we want to start? Should we start out with some entity structuring that, why the structure matters and how entrepreneurs should be thinking about it?
Sure.
Or do you want to start somewhere else? We can start somewhere else, because I was like, sure, Eric, that's the worst place to start. Like, if you're to start anywhere, don't start there.
No, it's just it's obviously so broad. I think getting a structure is probably the right place to start. And I would say just keep me honest on like where you want the conversation to go. But I think two things. I think just a couple of comments up front, Eric, that set the scene for what we want to be talking about. I think when we talk about like structuring more broadly, I think it's just structuring is essentially a conversation that, right, you have that about like what happens when things go well and what happens if things do not. And if you can answer both of those honestly, I'd find generally like the structure can almost like design itself. And, I think it's also important to acknowledge that I think in some cases people like look for well, what's the right structure? Like, what's the right answer? And I found in my experience that every situation is obviously like unique. And at the end of the day, things generally work backwards from the founder, the owner, the CEO's perspective on like what feels right to me. And, what can feel right to one founder can be not right to another founder. So I think there's a lot of, when it comes to, when I'm working with, with certain partners, all roads generally like lead back to like, where do we want to be in 5 years' time? And then you work backwards in terms of like, okay, so what's the right structure or structures that preserve that optionality or that flexibility or best set you up for right what it is that you want to achieve. And then just one other point that you'd mentioned, with your friend and his, this growth equity, this private equity investor, which is fantastic. But I think just to call out on that point is, again, I found in my experience that people just use the generic term investors quite broadly. And I think it is important to acknowledge that there are very different types of investors, and each investor can have different types of risk profiles, return requirements. And I found sometimes when, partnerships haven't necessarily gone the right way, it's because there's probably been a mismatch in terms of how the franchisor or the franchisee has been pitching the business and the type of investor they've been after versus the type of investor they've actually got. So you could take as an example, sort of two extremes. One would be like a landlord, relatively risk-free. They're after a yield. They're all about sort of certainty, predictability of income, like principal getting paid back, but it's more of a yield type return. At the other end of the spectrum, you've got like a venture capital investor who is, okay, I'm happy to do 20 investments and I don't care if 19 of the 20 fail. If one of them makes a 100x return, then that's how I make my money. And that's obviously kind of a hockey stick type growth, but they're very, very different. And I think and we'll probably flesh out in what we're talking about. But I think whenever you're looking to raise capital, it does require a really honest assessment on what type of business are you raising capital for? What type of growth do you reasonably project? What does the business look like? Because, again, when deals generally or partnerships don't necessarily work out, it can be as a result of unrealistic expectations that result in the entrepreneur and the investor being disappointed for years to come. So it's one on being like really thoughtful. And I think as we're getting a lot more sort of like transparent in the world of different investment classes, investors are also doing a much better job, I think, of being clear in what like their risk and return requirements look like. So, right, entrepreneurs like us can better match and find the right investments that suit the right business. So
That's a
long-winded way of just sort of saying like you've got to like match things, kind of like match things up the right way. And I feel like it can sound like an obvious step when I'm talking about it, but it's a step that, more often than not is overlooked.
Well, I thought you were going to come in here and give all the answers, and you came in here and be like, I'm not going to give you all the answers. I'm just going to leave you more confused than when you got here. But I think it's the right angle, because even stepping back into like an entity to form, LLC, S-Corp, sole proprietor, C-Corp. You talk to an attorney and you ask them, what's the best one? With a general question like that, what's the best one? Or you talk to an entrepreneur, they're going to, the attorney is going to give you the best one from a risk mitigation standpoint. A CPA is going to have a different angle. They're going to be thinking somewhat about risk mitigation, but that's all the attorney thinks about. A CPA is going to be thinking about it from a tax standpoint. You talk to an entrepreneur, they might think about it from the best one in their mind is going to be what's the easiest one. And, they're not going to, if you just ask them that straight up question without giving them any context, that's probably what you'll get. In reality, there's a lot more that goes into even just setting up the right structure. I was talking to an entrepreneur the other day. They are still, as a sole proprietor, making, well into the six figures and paying a ton of taxes and not having really any risk mitigation that comes with some, an entity, at least some type of level of risk mitigation, but paying way too much in taxes, not having any type of protection. And I don't know how that would look on a sale. So, they're getting advice from somebody that says, just be a sole proprietor, and they have a CPA. I'm like, what kind of CPA is telling you this is good? So I think it's just good to take a step back. Even from that, the person that you're asking questions to, you need to understand, you need to ask them better questions. And hopefully with this podcast, you will have better questions to ask the people that are advising you. And then, like you said, what's the goal? I mean, a franchisor, their goal, I mean, they want cash flow, but that's enterprise value. They're building enterprise value, and the return for an investor early on is creation of that enterprise value. A franchisee will have some enterprise value creation, but my friend, as an example, selling at an 8x multiple, that's not common for a franchisee. That's a lot more
Correct.
common
Yeah.
for a franchisor. So it's like, what's the goal and what are you using capital for? So where do you want to go next with this? Because I mean, you are much better at structuring these types of conversations than I am. But I'm glad you want to take a step back to bring in the complexity and looking at things from a different angle, not just like, hey, give me the answer here.
Yeah, I mean, just to add to what you said, Eric, 'cause I think you're spot on, but I mean, you could even like correlate it to the quality of an AI prompt, right? The more context you actually provide it, like the more thoughtful and better the response is actually going to be. So when it comes to, forming an entity, which it sounds like, again, an entity, and we can talk about some of the different types of entity, but um, forming an entity is absolutely the right thing to do because in the US, it limits um, liability at like the corporate level and it doesn't make you personally liable. So I think like we can talk about what different types of entities and things look like, but I think that's a really important like distinction. It's almost like you're building a separate house and like there's a separate foundation and like that entity is sort of like the walls and the framework around that, around that foundation. But to your point, whether it's the CPA, or anyone else that you're actually getting advice from, you don't just go to them with the open-ended, hey, what do you think? I'd actually go to them with essentially like a page of bullet points that is, lists out as many details and I think based on what you know today, and you won't know all the answers, you're almost giving them a one-page cheat sheet of like, here are all like the salient points that I think you need to know that's going to help you with your decision. Are you going to have multiple shareholders, right? Is this a business that you see producing cash over the next 5 years? Or is it one where you can see that the bulk of the value is going to be realized upon exits? What type of business is it going to be? Things like that are going to like, I think help guide ultimately like the right decision. And it can be one where, you also, like doctors or other things, like get a second point of view. But I think that's sort of like really important on, um, getting to a quality person, but giving them quality information so they can be thoughtful, in their response.
Attention, franchisors and franchisees. There are two really important resources that I want to share with you that will help you avoid costly mistakes and increase your enterprise value. The first is our free Facebook group. It's a community that has over 4,000 franchisees and franchisors in it. When somebody asks a question, they get honest and authentic answers from multiple perspectives. You can join the group for free over at franchisesecrets.com/Facebook. The second resource I want to share with you is if you're a franchisee and you want to be around a community of successful Zs and other brands and in other industries, this is why I created the Franchisee Mastermind. If you want access to the best single and multi-unit owners to know what they're doing, or if you want to be around other multi-brand owners, then you'll want to check out my Franchisee Mastermind. The reason why people join is they want access to my Rolodex, my connections, to each other. They want a shortcut success, both short-term and long-term. Links will be in the show notes or at scalablefranchise.com.
I want to dig into entities a little bit. Before I do that, you were talking about investors, and you got like an angel investor, a venture investor, or a real estate investor, and they all have different risk appetites. And those are general terms. If you're talking to investors and you're thinking everybody is an investor and they say they're investors and they like to invest, they should know what kind of investor they are. And they can, I mean, like what we do in our masterminds is like we have multiple different investments in different, as an angel, as in venture, in real estate, and different types of passive deals. But like my angel or venture allocation is pretty small compared to other parts of my investment portfolio. So the investor that you're going to doesn't have a portfolio. They don't know how much they allocate to what part of investing. Then they probably want the best of all worlds, or they really don't care. And it might just be easy money to get, which just because it's easy money to get doesn't mean it's the right money. You want people that really understand your investment and going back to Adam's point, what the goals are with that. So I think that I just wanted to kind of hit that point again. So you should understand your deal and what kind of investor you're looking for. So when you go and talk to investors about it, it's really clear of what kind of deal that is. If you kind of had to explain that to the franchisee looking for money and the franchisor looking for money, what kind of investor would each be going for? Or is there a real answer for that? And then let's dive into entities a little bit more.
Yeah, I mean, the example I'd use on the point that you just gave, like if you owned a building that your business operated in, Eric, right? The building is stable, appreciating, low drama. The business is exciting but volatile, right? A real estate investor is going to love the building. A growth investor is going to love the business. But put them together and neither investor is going to get a clean deal. So in some cases, I also think when people are speaking to investors, I view these as like two-sided conversations. So you should be asking the investor, like, what's important to you in your investments? Like, how do you think about risk? How do you think about return? So even if they're not necessarily articulating it the right way, you're still learning from them in a way of, possibly understanding, hey, based on how this investor or this potential investor is responding to me, is this the right fit? To get specific, I think back to, with a franchisor and a franchisee hat on, I think in the world of franchising, today, Eric, I think there's two, I think at the highest level, there's two common forms of entity structure. There is a LLC, limited liability company structure, and then there is there's a C-Corp, C corporation structure. They've each got their pros and cons. And again, I think when it gets back to the asterisks, like it depends on what type of business you're involved in, that could like lean itself towards like one structure or the other. But I think, and if we want to come back and dive into some of those pros and cons, we can. I think though, where it's like really relevant, whether it's an LLC or a C Corp, and this is both for franchisors and franchisees, but I'm all about creating entities and structures that protect your investments. And usually that involves multiple entities versus a single entity. So I'm going to focus on the franchisor for a second here. And generally, there are different parts of a franchisor's business that, again, have got different, risk and return characteristics. So it's generally good to try and like separate things, as best you can. So like the example, I like to give here is if you own 3 lemonade stands, right? You could run all 3 of these lemonade stands out of one entity, or you could create one parent company that owns 3 separate companies, one for each stand. And where that is beneficial is if something bad happens to one stand, it's not going to bring down like the other 2. So there's a little bit of like where you can there's risk protection there as a result of how you structure, how you structure the entities. There could be one where as a franchisee, you have multiple locations in different territories. And again, like it could be one where instead of having it all under one umbrella, you can separate based on the different territory. I personally like that as well, because I think the more separate entities can be, knowing you generally have like different managers and levels of expertise that go into that specific entity, you can also then align compensation, performance, and other things to performance of that individual entity versus everything getting sort of like commingled together. So again, sort of like done in a way where It can not just be good from, your own sort of like risk and financial protection perspective, but also in your ability to attract and hire talents.
So I think as a franchisor, like my go-to would be a C Corp with other different types of entities holding different assets. Maybe it's IP, maybe it's real estate, maybe it's different things.
Yeah.
As a franchisee, like what are the advantages, disadvantages to having like one hold co that owns, call it 12 locations? Or is there an advantage of each of those different locations having a separate entity, separate LLC? And then is there anything else that a franchisee would want to have a separate LLC for? Maybe it's you got the hold co, you've got separate LLCs for each location, and then maybe there is one that holds the franchise agreement, or one entity that is the main one that has some of these employees that might be shared, and they can share out employees different ways. So I gave you a lot there, Adam, but those are
Yeah.
questions that I get often. So can you bring some clarity to that as a franchisee?
Yes, I would say, despite what is some more upfront paperwork and admin that you need to do to establish different entities, the more you can actually separate entities, and that could be based on like each location. Like, let's just say you have 12 locations as a franchisee. I would advocate having 12 separate entities, and the lease that is actually signed is sort of housed in each entity. Because again, if something goes wrong with one particular location, you can close that entity and it's not going to bring down the other 11. There's a really nice sort of like ring fence and separation between the entities. Conversely, there's optionality where if you wanted to sell one location or two or three, pick your number, you have the flexibility to do that. And that's also easier for the buyer to get their head around, because you've got separate books and records for each entity. So also just like that as a way of like better practice internally around sort of like maintaining books and records. So I'd say there's probably just better financial discipline that comes with a structure like that as well. Does that answer?
That does. So you can form entities. Most people are like, whatever state I'm living in, that's where I'm going to form my entity. They might not say it like that, but like they don't know the differences. And I wouldn't say there's a ton of differences in the different states and where you form your, let's just call it an LLC for now, where you form your LLC. Privacy might be one of them, because certain states, I believe, have a bit more privacy in regards to the owners, or like who's registered there with that LLC. And others, I don't know if it's true today, but I know that Delaware, even with an LLC, had a one less year of liability on a lease. So landlord could come back and say, hey, you didn't pay me X, Y, and Z that you were supposed to for the 3 years ago in with this particular entity and this landlord. Delaware had one less year of liability. Well, that became important to us when we built out 12 solo salon locations, because you just never know what's going to happen. You got to plan for the worst. And we never had to take advantage of any of that, but that was important to us. Think about it. 12 locations, very expensive rent, over, one less year of liability in each of those. It was worth it to us to form those in Delaware. So any nuance between the states and, where you would want to form that LLC.
Yes. I think you said it well. I'm biased towards Delaware, but and I'm biased towards Delaware because it's the state, Eric, that actually has the strongest case law precedent, and I'd say it takes the most sort of like pragmatic and commercial view to running a business, and like what happens, right? Should there be legal situation? So I think the more case law, again, in the spirit of downside protection and like looking after your own interests. And again, I think there's other states that, have got more of a case law precedent than others. I think though, a distinction for those listening is, if someone's saying, well, hey, I've got a business in Colorado, can I still incorporate in Delaware? The answer is yes. There is a difference between where you incorporate your business and where where you may have like physical locations. But again, I'm generally a fan of, you kind of go to where there's the strongest sort of protections. And in my experience, that's actually been Delaware.
All right. So I'm a fan of Delaware. I have some of mine are in South Dakota because it's easier. You will always deal with the more protection that you want, the more complexity. You talk to any attorney that's helping you with your trust and complex entity structuring to mitigate risk. The more complexity, usually there's more risk mitigation, but there's also a trade-off of ease. And it's the same thing with this. If it's an LLC that risk mitigation isn't extremely important, then you might just want to hold that in whatever state that you're in. But that's just, kind of goes back to the original conversation. There's not a clear answer to any of this, but you just got to ask the right questions and understand the reasons why you would or would not incorporate or start an entity in these different states. And complexity might be one of those reasons. Also, I'd say if you are going down the Delaware route, then if you have multiple LLCs there, it's easier to just, have that in one state. So what I wouldn't want to do is have one in Wyoming, one in South Dakota, one in California, one in Delaware. Because every state, you probably have, that's just complexity that's not needed. I don't think it serves any benefit. So any last comments on that before we move on to like tax reasons why you would want to have different entities?
No, I think just a theme that's just coming up hearing you speak is actually around that we're talking about, today is around mitigation in general, right? We're looking at it like as risk mitigation here when we're looking at entity, where to incorporate. The entity also has like financial mitigation. It also has tax mitigation. And when we talk about, equity raisings or like investors, we're also talking about, sort of like risk mitigation with investors as well. So I think all of this just falls under the broad umbrella of, sort of like protection on the downside, which is, again, like when you're putting your hard-earned time and capital into any business, be it as a franchisor or franchisee, these things are just really important.
It goes back to the very beginning. We talked about having a CPA and attorney. You're going to get, different reasons for both of those. And attorneys, it's all about risk mitigation, and CPAs all about taxes.
Yeah.
Not paying, not legally paying as much as you as you need to be. Like, oh my God, Adam, I talked to so many people that are paying way more in taxes than they should be. And one of them is just a simple entity formation, and it opens up a lot of possibilities for tax mitigation. So let's talk about that. Let's start at, unless you wanted to talk about something else or had another comment, let's talk about the C-Corp, and probably the biggest reason to save an absolute ton of money on taxes is a C-Corp, and there's reasons why.
Yes, and it's got even better through was it the One Big Beautiful Bill Act?
Yes.
That sort of acronym from 2025. And what it means is for if you incorporate as a C corporation now, what it means is if you hold your business for 5 years, and we'll get back to different timing requirements. Basically, the first $15 million of any long-term capital gain will be exempt from federal capital gains tax. So,
Exempt.
there'll still be
What does that mean?
Exempt, which means you do not need to pay it. Depending on what state you live in, there'll still be, various sort of like state or city city taxes, but if I'm taking a long-term capital gains rate at 21%, and just like use that as an average, that would mean on the first $15 million capital gain that you realize when you sell a business, you're saving $3 million in taxes.
That's real money. Like that really happens, doesn't it? Like this isn't just some wacky strategy out there. Like why does the government do this? Like, why would the government say, you got your $15 million, you're not paying any federal taxes on that? Why do they do that?
Well, I think you've got, what this does is it helps the business, I think, sort of like really incentivize the next generation of entrepreneurs. And the fact that, sort of small and medium businesses are sort of like the cornerstone of the US economy. So, this is one where, and obviously as a business entity, there's all sorts of other, tax deductions and other benefits that you can realize. But I think the point's a really important one, Eric, because too many people just focus on like gross proceeds versus like net. And, as in the example we just gave here, like $3 million is real money. I don't know about you, but I'd rather have an extra $3 million to spend than to give it to Uncle Sam.
Think about that. That's saving. Like you're just keeping that in your pocket for having the right entity formation. And how long would it take to make $3 million, especially if you're just investing it? Like, how much capital would you have to have out there on the streets earning to make $3 million? And it's a lot of capital. So there's a lot of different ways to look at that. But the government writes the tax code to incentivize entrepreneurs to grow the economy. At least that's my take on it, and a lot of people's take on it. So they are doing these types of things, like what Adam's talking about, to incentivize entrepreneurs like us to grow businesses. And it's absolutely it's incentivizing us to grow more franchise entities. And that's what we're doing. Like you and I, we've got another one that is not, launched yet, but will launch next year, that you and I are partners on as a franchisor. We are the franchisor with a few other people. And we're absolutely setting this up as a C-Corp, so we can save a lot of money. Anything else that you would comment on that? Because I know we're coming up against time, but what's it called? Like, how do people dig deeper into that?
Yeah, so it's called a QSBS exemption, which is an acronym for Qualified Small Business Stock. It pertains to sort of Section 1202 of the tax code. And that's the only specific paragraph I know of the tax code, Eric. I think just the other comment to note that was a benefit with the bill, with the act last year, is up until then it had been a very binary 5-year clock, but where there's some other layers that have now been introduced into the bill is you need to hold it, like I said, for the full 5 years for this 100% exemption on the first 15 million. You get a 50% break for 3 years and a 75% break for 4 years. So, for those where, the chance does present itself to be opportunistic before a 5-year, clock ends, there can still be some benefits, albeit not the full one. But, again, all these are like incremental benefits that, accrue to those that choose to, run and manage their own businesses. So, it feels like a really, really unique and beneficial time to be thinking this way.
Okay, I'm going to give a 30-second wrap up. You give a 30-second wrap up. If it's me, what I would do if I'm interested in this type of stuff, I would go into Claude. I would take the transcript of this episode, put it into Claude. If I didn't take the transcript, I'd at least say, tell me about QSBS and entity formation. How should I be thinking about it given my scenario? Ask me questions about my business so you can help me as a sparring partner have the right entity formation, be thinking about tax mitigation, and even be thinking about raising money. And I would put that into Claude and start having some conversations around that. That's my quick takeaway. What about you, Adam? 30 seconds.
I think you've stolen all my thunder, Eric. I would just add, again, it's in the detail of the prompt on AI, where get it to give you its detailed assessment. Ask it for as many questions as it needs to ask you, so it can be more thoughtful in its response. But again, I think beyond AI, I think it's also just like it's reaching out to other entrepreneurs and people. I think this is where, again, there's no one size fits all approach, and the stronger the quality of information that comes your way, it then gives you what you need to feel better about whatever it is decision wise that you need to make.
All right. Next up with you and I will be actually raising money, but that's for another day. Thanks, Adam.
Thanks, Eric.
Thanks for listening to the Franchise Secrets podcast. Links to everything can be found over at franchisesecrets.com. And if you want my help with anything from starting your own franchise to growing your current franchise business, please visit scalablefranchise.com.